Okay, our preoccupation with stocks can be rewarding when the market is on a post-crash roll, but history has shown that investors should have diversity, and fixed income is one of those assets they should be diversifying into. To look at the opportunities, Mark Paton, the CEO of FIIG, joins us. Mate, great to see you.
Good to see you too, Peter.
I'm glad you didn't yell out bull when I was doing that comment. I do a comment in front of a smart person. I always worry they might say, hey.
Well, I think it's interesting. Australia's debt level to GDP is one of the lowest in the OECD nations. So, interesting.
Yeah, it's good that they get onto it, but it doesn't have to be done as fast as they've been making out. The size and the scope of the bond market. Tell us.
It's a little known secret, I think. The Australian bond market is over $1 trillion in issuance. So that's $1,000 billion. It's made up of Commonwealth bonds, semi-government bonds, corporate bonds. The corporate bond element of that $1 trillion is just under $300 billion.
Okay.
There's over 5,000 bonds on issue from over 350 corporations. So that is a very active and deeply traded market. Almost as big as the ASX by market cap, which is about 1.4 trillion.
Okay, so tell us about the different sorts. There's fixed, floating and inflation linked, and also link the yields that you expect.
So within the corporate bond definition, there are, the large types of bonds are fixed rate bonds, floating rate bonds and inflation linked bonds. So fixed rate bonds is basically where the risk premium that the investor gets paid is added to whatever the interest rates are of the day, and that total rate is set at the issuance of the bond and paid for the life of the bond. If you're a wholesale investor today, you can invest in corporate bonds fixed rate for 8.75% in a portfolio.
That's a nice return, but how do you become a wholesale investor in bonds?
So there's a test in Australia which ASIC governs, which defines the difference between a retail investor and a wholesale investor. And it's largely about the amount of funds that you have to invest, and it's about the capability that you have to understand the underlying instruments.
I've got $1 million, and I'm currently 100% in stocks because I want 8.75%. Will $1 million get me the wholesale rate of 8.75%?
There's a number of tests. It could. It's up to your accountant. Your accountant will decide whether or not you meet the ASIC requirement, and they'll accredit to you. If you do, you would sensibly, no disrespect to your age, Peter, but at some stage through your life you go through an accumulation phase. You're invested in equities and you're looking for the capital growth.
That's right.
But once you've generated your pot of wealth and you want to balance how much you want to grow and how much you want to protect and how much income you want to get from it, you would sensibly allocate some percentage of that to fixed income. If that were 20, 30, 40%, depending on your portfolio, you'd allocate that to that. You'd know that the $100 that you put into an investment asset, you get that $100 back at the end of the life with relatively little capital volatility, and you'd have a defined income coming off the back of it.
Yeah, but retail, if I'm classified as retail, I'm only getting what?
You're actually getting still pretty good rates. So corporate bonds that qualify for retail investors today about 6.95%.
Okay.
And so, simply what does it take to invest in portfolio bonds? Well, to hold a bond, you need to have a custody account. A custody account is a free service that you can get at FIIG. It's very much the same as opening a chess account. You open a custody account and you hold your bonds in there. You can get internet access to it. You can see your coupons, all your corporate actions, everything reported online and available, real time.
But you and I understand that whenever you get better rates than a term deposit, and term deposit is probably the safest of all because the government's going to back them, well, for a lot of them anyway. What is the risk factor on an 8.75% yield?
So corporate bonds, largely most of the bonds on issue in the Australian market are rated, so they're rated by Standard & Poor's and Moody's.
Yep.
To build a portfolio of investment grade rated bonds, you'll be earning in the high 7%. So quite a big premium compared to, say, bank deposits.
Yeah.
A lot of those bonds come from the banks themselves, so the banks issue term bonds, big industrial companies, big insurance companies, and a lot of infrastructure assets. So entities like Sydney Airport, the Dalrymple Bay Coal Terminal, the Melbourne Convention Centre, they issue these different types of bonds, some fixed rate, some floating rate, and some inflation.
So, mate, what you're saying is to get a return like 7%, you have a lot of companies in there. You're not exposed just to one.
Correct.
Who could go belly up. Even though it might be a well-known name like Babcock and Brown, those companies can disappear.
Correct.
So, but if you play your game right, you can get a whole collection of corporate company bonds.
I think the interesting thing about investing in bonds is when you establish a portfolio, you're actually just mostly interested in the underlying yield. Because there's no real capital upside, although that can happen in inflation-linked bonds, but because you're not really there to get the capital upside, whether you move out of a bond that might be maturing or a risk profile is changing, at the end of the day, what you're most interested in is what's the all-up yield that you're getting out of that portfolio. So you're not trying to pick a portfolio of bonds like you're trying to pick stocks. You're trying to get a diversity in your portfolio. You're trying to get an overall yield, and you're trying to get a balance, I think, between fixed rate, floating rate and inflation.
And obviously the big wholesalers, they actually go through and pick their 10 companies they want to invest in. But your job is you actually put them together for smaller investors so they get that kind of diversity. That's what FIIG does.
Correct. You can now invest in individual bonds in $10,000 lots. So bonds are typically traded in much bigger parcels in the professional markets. FIIG has been able to reduce that minimum parcel size down to $10,000. A portfolio of 5 to 10 bonds will get you quite a bit of diversity, and it will enable you to get a mix of different coupon flows. And the other thing you can do with a portfolio of bonds is they all have different maturity dates, so you can have them structured in a way or aggregated together in a portfolio so that every month you get a coupon check, and so you've got a good regular monthly income stream coming out
great stuff.
of
So
bonds.
if people want to know more, the website?
FIIG.com.au.
Two eyes.
Two eyes in the FIIG.
All right, mate. Thanks for joining us on the program.